Good evening, everyone. So actually, it's as you can see, Steve's side is sunny and he's wearing a short sleeve. So we're really thankful tonight that we have a special guest today, Steve Palise from Palise Property. He is actually taking his precious time out of his holiday to do this webinar for us. Thank you so much, Steve. And
Um,
so I'm so excited to kickstart this session on why commercial property will be the best performer in the next 5 years. And without further ado, I just want to introduce Steve, who is one of the Australia's top expert in commercial and residential lending, investing. So I will just pass it to Steve to give us an introduction of his amazing journey.
Thank you so much for having me on. And yeah, like you mentioned, I'm in the UK at the
Yeah, tell
moment.
us where you are now, Steve.
I'm in Brighton, which is like south of London. But I normally travel around also. I just got back from Croatia and that. But as you know, like I travel probably about 3-4 months of the year and work remotely a lot. Because
Mm,
commercial property enabled me to do that. I
yeah.
started my journey and I bought I think 9 residential properties before I transitioned to commercial, and then just buying my first commercial matched my passive income from 9 residential properties, and
Wow.
then went down the rabbit hole. And then my focus started becoming, this is just for me personally anyway, on
Yeah.
net wealth and more
Yeah.
building that passive income to 500,000 plus. Because just again, this is just me personally, I feel wealthier having a $500,000 passive income than I did
Mm,
a 20 mil portfolio that was new to
yeah.
the gig. Even though on paper I'm still very wealthy, and this is where the people watching need to assess why they're buying property. Some are
Mm,
building a wealth base and a legacy
mhm,
for their
mhm.
family and kids, and they want the prestige of having a large wealth base.
Yeah.
Others looking to just have some passive income and enjoy holidays a little bit more, like me. So you got to find that, and then you'll mention as well. You got to tie up what your lending capacity is as well, and
Yeah.
that's another benefit of commercial, which you'll explain some of the
Yeah.
ways commercial actually lets you keep progressing your portfolio, where
Yeah.
residential servicing stops it.
Yes, correct. Yes. So thank you so much for sharing. I think a lot of people's dream is to have the passive income running. So you made a really good point and a good introduction, good start to kick off the session. Thank you,
All
Steve.
right, let's do it. I'll share my presentation if that's all right.
Yep.
All right, let's just get into it. All right, so yep, everyone knows who you are, obviously, and I'm Steve Palise. I'll give you a bit of my background. Today, I'm just going to try to cover as much as I can on commercial, mainly how it works, the benefits. You'll talk about lending,
Yep.
but I also want to give some like hot spots of where to buy, a bit of a market update, and just even how to find good commercial spots, because there's a lot of myths around commercial. So just a general overview, but we'll start at the beginning for me. I'm actually a chartered engineer in mechanical and structural engineering, even though I got a degree in robotics. So I used to
Wow.
design like robotic limbs and defibrillators and stuff like
Mm-hmm.
that. And then I sold to the dark side and went and started designing mining equipment, because it literally paid double for half as easy work. And then while I was doing that, I was building my residential base. So like I said, I got up to 9 properties before I bought my first residential. And then because I was looking at property all day, every day, helping my colleagues, helping the CEO buy, I was like, I'm doing this during my engineering work hours. Why not do it full time? And then started helping friends, friends of friends, etc. And then it says here 1,500 property acquisitions under my belt. It's actually about 2,000 now. So
Wow.
it's quite a lot of deals over the last kind of 10 years.
Mm-hmm.
All the market's been very kind to obviously everyone as well. So some great outcomes and some clients that have bought 20 plus properties through me just themselves. In regards to my company, I'm fairly fresh. I worked for another buyer's agency to get my skill up, and then went out on my own about 4 or 5 years ago. And then the last 3 years, I've got awarded by Financial Review the fastest growing real estate company in Australia.
Wow. Wow.
Done
Congrats.
all the usual podcasts and TV and all that type of stuff as well. But yeah, the big thing is I've actually got 3 books in stores, and this I I'm known as the commercial guy in Australia, um,
Yes.
because of my commercial book. That was the first commercial book that hit the market, because
Mm.
before that there wasn't really anything. And then, funnily enough, I actually didn't enjoy writing the book. It was like a year's worth of 3 nights a week for 4 hours, sitting there at night time writing the book. But
Wow.
I released a residential and a development one because I started getting known as the commercial guy. But I don't want to be known as the person who people think are going to push them into a certain kind of pathway. Like
Mm-hmm.
residential has some awesome advantages, like leverage. That's how I got 9 properties, whereas you don't have the same advantage in commercial. And then
Mm,
those that want to accelerate a bit further, I've done some developments. So I wrote a development book. So I want to be known as the guy who just gives wholesome advice. So
yeah.
even though today I'm going to talk about all the positives and some negatives of commercial, I'm still a very big advocate for residential and development as well.
Mm,
Um, Sold 50,000. You're going to send out an email and let you know, but everyone watching this can get all 3 books for free.
yep. That's the
Um,
exclusive gift,
Yep,
everyone.
I've also got a commercial course, like a 10-hour commercial property course. So I can give that to you guys access for free as well. So that's all. So there's no secrets. So like you don't have to, even though I'm a buyer's agent, you don't have to use my services. You've got 250 pages in a book and you've got 10 hours of walkthroughs of how I assess commercial properties. So you can do it yourself. The benefits of using a buyer's agent, I'll be honest, is so you don't make a mistake. And I'm going to save you hundreds and hundreds of hours looking and dealing with agents and things like that. So there's advantages there. But yeah, get all 3 books, and that way you can kind of read all through and make a judgment based on your circumstances, what type of property is right for you. But let's get into the commercial one because that's why everyone's here.
Yes.
I'm gonna cover lots of topics, and I want it free flowing. So if you've got
Mm,
questions on these, pop it in the chat, and we'll
yeah.
get to it at the end, and I'll answer these questions. Because there's quite a lot, and you can go off on tangents. But generally, the things we're going to cover commercial are the types and the myths. The myths is a big one. This is where most people don't buy commercial property, so we'll discuss that. The cash flow, so what the difference is between the residential and commercial in regards to cash flow. How you grow a commercial portfolio, the due diligence, which to be honest is the biggest one. Like we need to do, each report takes around 20 to 30 hours on a commercial property. To put that in perspective, I can do a residential due diligence report in about 40 minutes. So
Wow.
there's quite a bit difference in time. Then
Mm,
looking for the property as well. We're going to touch on that after due diligence. How you look for a property is completely different because you don't have all the online data like you do for residential. You can't just go on
mm,
SQM and look at vacancy rates because it doesn't know like a doctor's surgery. What's the vacancy rate for that? Like, what are your comparables? And then a warehouse, the vacancy changes on the size of the asset, the access, the height, if it's got a crane, the size of the roller door. There's quite a lot to unpack there, so we'll talk about that.
mm,
You'll cover lending and finance, which is good. So we'll go over
yep.
some different types of loan types, the advantages and
Yeah.
disadvantages of commercial
Pathways.
lending.
Yeah.
Yep. And then the last one I'll touch on is value add opportunities because one of the myths is people say you can't do value add on commercial, and I'll show you that there's actually more value add potential with commercial. So we'll touch on all that. Jocelyn told me to shut up if I'm talking too much because as
No.
you know, when we had lunch, I can talk underwater. So just if you
Yes.
think but let's get into types of commercial. Most people know what types of commercial are: industrial, retail, office. Special is things like one-dimensional assets. So like we've bought a cinema, we've bought petrol stations, car wash stations, things that are specifically designed for one use. And if
Mm,
you use that tenant, it doesn't have the versatility to become something else easily. So those you can generally get really, really high yields, but it comes with risk and it also comes with you need a lot of knowledge in that type of asset class. Like you need to be an expert basically in that asset class.
mm,
Um, these are the things, the myths. Every day I have to talk to people about these myths, and they think, oh yeah, first one is commercial has really large vacancy rates. Whenever
yeah.
someone says this, they're referring to a retail shop around the corner from them that sat there for 2 or 3 years vacant. The counter argument to that is don't buy that asset. Like don't buy one that has that one-dimensional nature that will sit there vacant for a long time. And we'll talk about how to assess vacancy rate for commercial because it is different based on retail and industrial. But to let you know, industrial property in Sydney, most areas are under 2% vacancy rate.
Oh,
North Sydney, for instance, industrial vacancy rates are zero. Zero.
wow.
So when someone says, oh, they've got huge vacancy periods, the answer to the question is, well, what type are you looking at? You can buy
Mm,
commercial property that has a lower vacancy rate than residential. What confuses some people though is the main difference is In residential, you'll get it regularly. So you'll have a
Mm-hmm.
residential house. You might lose your tenant every 18 months, 24 months, have a week or two's vacancy, and then it goes back to the start and goes again. Commercial, so industrial, for instance, like a typical Brisbane warehouse, for instance, vacancy rates sub 2% as well in most areas you buy. Some are even like 1% low. You'll have your tenant on average for 6 years to 12 years, but the vacancy period will be 2 or 3 months. So the net result is actually the same as having one.
Mm-hmm.
The difference is, and where the fear comes from, is you need the buffer for that period. So your buffers are different with commercial compared to residential.
Yeah.
Um, However, there's also lower maintenance cost. You go buy a industrial property that's three concrete tilt-up panels and a roller door. The tenant looks after all the outgoings. There's
Yeah.
no maintenance. So when you've got a residential house, you've got air conditioning, hot water systems, roofing. Like you still need a buffer, but it's just for
Yeah.
different things. Whereas something like a retail, on average, you'll have the tenant for say 7 to 15 years, but then the
Mm-hmm.
vacancy rate in a good area is generally around 6 to 12 months. So again, it's the
Mm-hmm.
same net result. It just seems scarier in that moment in time that you might have a vacancy, but then as soon
Mm-hmm.
as you get a tenant, you have them for long term as well. So they're the kind of higher risks that we're talking about.
Yeah.
Uh, the next one is commercial properties do not grow. That is completely false and a myth that was started by residential investors. If you disagree with me, find me any industrial property in any capital city that hasn't quadrupled in the last 30 years. I actually released on my Facebook a post that came from CBRE, Knight Frank, and I think it was the other one. I think it was Savills.
Mm.
Uh, core logic data showing the best performing asset types over the last 20 years. And industrial Sydney was the highest capital growth. It beat residential.
Wow.
So it actually is a complete myth. Where
Mm.
another way, the reason this is a bit of a myth is different commercial assets will have a different growth rate. So a little quiet suburban retail will
Mm-hmm.
not grow the same as a well-positioned house. Similar
Mm.
high density office space won't grow the same as a house because one's got a land component, the other one doesn't have a land component. And as you know, the same thing for high density apartments. High density office space can be oversupplied very easily. And that's the
Yep.
risk with that asset class is if the market was to perform very well, developers are just going to build a 20-story office tower and capitalize, and that's going to kind of halt the market. So there's each type's got different risk profiles and benefits, and this is the hard thing with commercial because people just say commercial is risky. Well, no, not necessarily. You can buy very low risk ones. You can also buy very high risk. The same is with residential. If you go out and buy a house in a mining town and all it's got is mining and they shut the mine, you can still
Yeah.
do things. The way I explain it to people is I consider risk as like a staircase. So, like with residential, you're only 4 or 5 steps up on the staircase. So, you've only got to check a few things. As long as it's not in a flood zone, vacancy rates are really
Yeah.
tight, there's really tight supply and demand, you're generally going to be okay. Like, there's only 3 or 4 things you got to check that you can trip up on and make a mistake. Commercial, when we get to the due diligence section, I'm going to show you there's about 20 things to trip up on. So there's more work involved in assessing it. So there's a bigger staircase you can fall down,
Yes.
but the rewards are much better. You get the same
Mm.
capital growth, if not more, like I said with industrial. And this is the big one, you get 3 times the cash flow. So to put in perspective, most of the stuff we buy is between a 5 to 7% net yield.
Wow.
And that's the key word, net. So
Mm.
a 6% net yielding commercial is net because the tenants pay 100% of the outgoings.
Yes.
Right? So to keep it simple, if you bought $1 million commercial on a 6% net, you get $60,000 into your bank account because the tenant covers council rates, maintenance, water rates, all those type of things, insurances. That's net income. You go and buy $1 million house, and which is tough nowadays, but let's say you go out and buy Western Sydney, for instance, out somewhere in the Parramatta Council in Toongabbie or something like that. $1 million asset rents for around 550 a week. So that's a 5.5%. Oh, sorry, not 5%. That's 25 grand. It's around a 3%,
Yeah.
3.5% gross yield. You've still got council rates, water rates, maintenance. So that actually drops it down to about a 2% net yield. So
Mm,
one I'm getting 6%, one I'm getting 2%. So I'm actually getting three times the cash flow, which is
mm,
so anything you can do in residential, I can do three times as fast or three times as large with passive income with commercial. So
yeah.
that's the point. The
Yeah,
last
so
one,
Steve, I have a question, like do you have like some investors coming to you say, "Hey Steve, I'm looking for a residential investment," and then you convince them and then they end up buying commercial? Like do you come across a lot of these kind of clients? Because
yep,
they're
quite
comfortable with
often.
residential.
No, quite often. So they'll come to me for residential, and we'll actually explore and find commercials a better option for them.
Mm, mm,
Inversely, we get a lot of commercial investors, probably more commercial investors that come to us, and I actually recommend residential.
mm.
And we'll touch on that if you want. I'll go off on a
Okay.
bit of a tangent. All right. So what your strategy comes down to is what you're trying to achieve
Yeah.
over what time frame versus
Mm,
what you've got to work with finance.
yeah,
So
yeah.
so one of the key points. Let's do some dramatization. We'll go to examples. If I get quite a lot of like 25, 30 year olds who come to me with $150,000 saved, and
Mm,
they might have one or two residentials or no residential properties. They'll
yeah,
come and say, "Oh, Steve, I want commercial because I want a passive income. I want to retire as soon as I can on a passive income." However, they've still, if they've got still servicing, which is that third point of what's their finances allow, and we can
yeah,
keep buying 90 and 100 and 105% residential loans. If I go out in commercial, this is what you'll talk about a little bit as well.
yeah.
Most lending is 70%, even less
Correct.
if you're buying lease stock, 80% for a couple lenders, but for
Yeah,
argument's sake, let's say 70%. I
yeah.
could theoretically go use that money and leverage it at 90% and get three times the wealth base and then use that as a delayed strategy. So go for 5 years, get some capital growth, then sell or re-leverage and move into commercial then because in reality, a 25, 30 year old's not going to retire at age 35. Like I can retire, but I still work because I want to keep busy.
Mm,
I don't work 6 days a week, 12 hours a day. I'm very 10 till 4 or 5 days a week. But it gives you that option. So leverage isn't the one that decided it for them, even though they wanted a passive income. So I'm going to say, no, go
mm.
residential. We've got more
That's
power
true.
here. The
Yeah,
op
yeah.
get a lot of 55-year-olds, 60-year-olds coming to us looking to retire. So they want to set up their retirement with a passive income.
Mm-hmm.
Most retirees don't care about net worth at that point in time
Yeah.
because they want to use the income. If you're going to buy residential, unless you're going to sell down and put the money into something else like shares or high yielding, they come to us and say, oh, okay, look, in the next 5, 10 years, we need a passive income. Me going out and buying, even if they've got the borrowing capacity, so say they've got really good servicing, they've paid off their house, etc., and they're still earning good income, even though I could theoretically go buy them more for residential, buying a negatively geared asset is not going to help them with a passive income for retirement. So it's
Mm,
all about getting a high yielding asset. More importantly, a low risk, high yielding asset that's just going to fund their retirement securely. And like I said, you get three times the income. So, as opposed to buying residential, I could buy a commercial and triple their passive income for retirement. So,
yeah.
that one's not their finance that's stopping it, it's what they're trying to achieve and what time frame we've got.
Mm,
They're the ends of the spectrum, and most people fit in the middle where they might
yeah.
have two or three. A lot of the times people are forced to buy commercial, as you know, they've with interest rates how they've been the last 5 years increasing. Now they're coming down, but the last 5 years, most people servicing is what stopped them, not the
Yeah.
equity. So they've shifted to commercial because there's more creative lending options. So they've done it out of
Yes.
necessity to grow their portfolio. So there's that part of it. So don't ever listen to someone who just says this is the best strategy. You need to work out what you're trying to achieve, what time frame, what your lending capacity is versus residential and commercial.
Yeah.
Then talk strategy with Jocelyn or your team or my team, and then make
Yeah.
a plan from there based on your personal circumstances. And this is
Yeah.
why there's so many conflicting data for real estate. Everyone's got their little 2 cents. There's 1,000 strategies you can do. Depends what's right for you. Either
Mm,
option, you need to be going on get good capital growth, good income, and just build your net worth base that way.
yeah.
So I went off a bit of a tangent there, sorry. All right, and the last one we'll cover at the end a little bit as well.
Yeah.
When people say there's no value add, because that's just from lack of awareness. Every residential investor knows you can do a development, you can renovate, you can knock down, rebuild, etc. Just I won't give too much away yet. Commercial, you can still do that. Like, what's
Mm,
stopping you from renovating a property and developing it? But with commercial, there's some cool other ones we'll go into as well. So you've got all the usual residential, but then you've got all these really creative ways, and I'll show you some examples there.
Cool.
All right. So we're going to go into cash flow, and this is just a bit to prove what the cash flow looks like for a commercial. Don't worry if you're watching this on your phone and it's a bit hard to see. I'm sure we can maybe even share this presentation after with everyone saying, look,
Yep.
on a bit of a side note, any spreadsheets, etc., that I'm showing, you can actually go to policeproperty.com and download them for
Oh,
yourselves. Like
wow.
all my resources available. I've got due diligence checklists, I've got cash flow calculators, I've got return on investment calculators, I've got a lease stock calculator, which Jocelyn will talk a bit about later, about how to assess like your lease stock loans. Everything's free, so you can feel how to have a play for your circumstances. But I thought I'd show this for just again keeping numbers simple. $1 million
Mm,
property. If you're buying a 3 mil one, times it by three. If you're buying a 500 grand one, halve it, for instance. But just a generic 6% net yield, 3% depreciation. All I'm doing here is showing you the power, because besides rental management, which funnily enough, in some properties the tenant actually covers it, but around 30%, 40% of them they don't. Just giving you a look at the cash flow. So you can see, say, let's go a 70% loan at 5.5%, which is the
mm,
second box down. You're getting 60 grand income plus the 3 grand back at tax time. Again, that's just an estimate. Sometimes you get 10, sometimes it's zero based on the age of the property. The interest on an interest only loan is around 38 grand. So you're actually 22 grand a year positive from the get-go. So buying a property, 20 grand positive. Even if you bought a 100% loan, you're neutral to positive 5 grand a year. And I know that doesn't seem like people go, oh, why am I buying commercial? I haven't got a passive income yet. But you buy the same property with residential and you're 20, 30 grand a year negative. So all of a
mm,
sudden I'm 40, 50 grand a year difference in cash flow compared to what it was. Where it becomes really powerful, and I won't stay on this one too long because it's basically just showing you the risk of like, even if interest rates went up to 9.5%, you can still hold this asset. Like it's going to cost you
mm,
have 10 grand, 15 grand a year to hold the asset. If you do the same thing for residential and interest rates went to 9.5%, you're selling that asset. Like you're not going to be able to hold an asset that's negatively geared 60, 70 grand a year, even more so if you've got two or three of them. But this is just to illustrate that you can actually kind of get a little bit passive income, but more importantly, hold multiple assets and it not be detrimental to your lifestyle at the start. Again, you still get capital growth, which is the number on the right. I'm just doing some capital growth of 6% as well, plus the cash flow. But the real power of it, let me just go to the next slide, is what happens this. And I'm not saying to pay down a commercial necessarily. It's got to come with your strategy. For example, my personal properties, I actually let them pay off. So I do a 50% deposit on them and
mm.
they're debt free in 7, 8 years' time with no risk at all. So that's my
Oh,
personal strategy. But again, I could theoretically leverage more and buy more assets, but I don't need to. I've got my 500,000 passive income from that. But this is a
mm,
really powerful spreadsheet. And again, download it on my website, have a bit of a play. All this is doing is working out with the cash flow. So similar to the example before, this one we're doing a loan rate of 6%. Again, I'm just trying to
mm.
choose 30
Yeah.
year averages. It's about cash flow of about $18,000 a year. So year one, you buy the asset, you put a 30% deposit down. I don't want to sugarcoat, coming up with a 30% deposit for commercial is very tough. Like you can see with stamp duty, etc., we're $340,000 a year cash into this asset.
Yeah.
So like it's a big chunk of change. So I don't want
Yeah.
to sugarcoat and think like, oh, look how easy it is to get a passive income. However, let's pretend you took that from a residential asset and yes, you're still going to pay interest on that, but most of the time the residential debt will pay the interest because it's a lower interest rate than commercial. So this one is a standalone one, $18,000 a year. All I'm actually doing is, oh, I haven't put the extra repayments, but I've put the column in. But anyway, the remaining debt, all I'm doing is off that $700,000, taking off the $18,000 cash flow. So I'm not doing additional repayments or anything like that. Just doing that, and then obviously the cash flow increases to 22 grand the year after because there's less debt. Also, you get small increases on the rent. They're either fixed or variable based on inflation. The last
Mm,
3 years, we've seen industrial rents grow to 20 to 30%. So when people say, "Oh, you don't get rental growth either," that's false. But just simply, like just doing that same process of putting the cash flow back into the property, you can actually see after 13 years, the property is debt free. And all of a sudden, you've got $100,000 passive income from the property. To put that in perspective, If you bought this in residential, it's a 30-year pay down strategy with extra contributions
Yeah.
to pay it down. And you end up on $1 million asset. It ends up costing you about what, 1.7, 1.8 mil by the time you do all the interest and things like that. So we're getting 2.5 to 3 times the cash flow in about a third the time, which is really powerful. The extra repayment one, I forgot to fill in the blocks in extra repayments because I made this look presentation wise for the presentation. I did a $15,000, I think. Let me just double check. 662. No, 20,000. So I've done an extra $20,000 per year, just to show you, as you know, if you obviously chip off the loan early on, it
Mm.
accelerates way down, and that knocked
Yeah.
off 3, 4 years. So we actually got in 10 years' time, just putting an extra $20,000 to the asset, we've got up to a $70,000 passive income from literally just putting 20 grand in. And that's quite powerful because a lot of times people, especially if you're buying like say a self-managed super fund, you might be
Mm.
extra contributions which are tax-free to pay down faster. But this just goes to show like you can build a substantial passive income in less than 10 years with a commercial property because you've got that 3 times income
Mm.
compared to residential. So on paper, again, there's more to it than this. There's tax and different trust structures and how to. This is just illustrative, but it's just to show you guys there is power to commercial if you get it right and the property
Yeah.
stays. Okay. This is one I've done a just to grow the portfolio. I've done an example of just having a commercial only portfolio, just to
Mm.
show an example. I've also got this plan on my website, and I've also got a residential one to compare it to. But I'll show you the commercial one. I don't recommend this. This is just for dramatic effect. Similar to before, if you start off with one commercial property and you just basically do, I've got 30 grand additional contributions because everyone who's growing a portfolio obviously keeps saving money. And all
Mm.
I'm doing is I've actually only done 3% capital growth because that's guaranteed. If you get a 3% rental increase, you get 3% capital growth because that's how we value commercial properties. So that's an important point to touch on. Commercial is valued on a thing called cap rate. So
Mm.
the rents grow by 20%, or you can fabricate 20% extra rent, which will go into some value adds. The property is worth guaranteed 20% more. Whereas with residential, that's not the case. What the tenant pays has nothing to do with the value of the property. So all I'm doing on this one is $1 million asset with the cash flow that you're getting from the property, plus 3% capital growth, plus 30 grand a year additional savings. In year four, you could buy another commercial property, and then so on and so forth. You just let it fall out. So you can see over 10 years, this will be someone who, for instance, didn't have a good servicing, for instance. So either they're a low
Mm.
learner or they've got some history, credit history, or whatever it may be that's not letting them kind of buy and leverage up to residential. But the point I want to show is in 10 years' time, I've built a $4 million down the bottom, $4 million
Mm.
portfolio size,
Yeah.
and I've got $100,000 passive income just from 10 years of very simple structure. To put that in perspective, to get $100,000 passive income, you need around a 12 mil residential portfolio. So that's a lot more risk to have over. Also, a lot more risk early on because you're negatively geared and you're balancing. You have to
Yeah.
keep your job and things like that. But again, I don't want to sugarcoat. There's risks with commercial, and it's not as simple as these big spreadsheets that I'm showing. But I just want to show the concept of things can fall your way if you know what you're doing with commercial.
Yep.
This I touched on this before about due diligence. This is probably the hardest and the most annoying part with commercial, and where 99% of people who do it on their own fail. There is so much more to check with
Wow.
commercial.
Yeah.
Residential, most people understand it. If they buy in an area that they somewhat know and it's not in a flood zone or the house doesn't isn't filled with termites, they're probably going to be okay. Like long term, they're going to be okay. Commercial, just analyzing the data is really tough. You got to do things
Mm.
like contract review, lease review. You interview the tenants. You got to see they look at their P&L statements and their
Yeah.
rental ledgers. You do foot traffic analysis, road traffic analysis, competition analysis. Check leases are registered, vacancy study, occupancy study. We do a credit history check on the
Wow.
tenant, previous owner as well to see if they've disclosed anything. So there's quite a lot. Our due diligence report, again, if you check out my YouTube and stuff, I go through cases of going through it. Or my course actually gives you the checklist that you have to go
Mm.
through. There is way more information you got to do. Like I said, it's around 30 hours ish to do this report. Because you
Wow.
basically got to do when you get a commercial valuation, you got
Yeah.
to do plus all the investor side of things as well. The other annoying thing is a lot of this is grunt work. As I mentioned
Mm.
before with residential, if you want to look up the vacancy rate of a three-bedroom house in a suburb in Sydney, in Chatswood, you literally go to a website. There's lots of them. There's lots of, like, I go to SQM. This is the main one I go to for vacancy rates. And you can literally look at what the vacancy rate is and it gives you a graph of the history. Commercial, for let's say even industrial, there's no such website. You need to go on CoreLogic and find every comparable warehouse in that complex, the adjoining complexes, see if it had a leasing campaign. How long was the leasing campaign? Then you need to call two or three commercial property managers and find out what they've had on their books for the last year, how long it took to get fill the premises, what were the issues, and then you've got to check the size because a larger warehouse will take longer to tenant, but
Mm-hmm.
have tenant for longer because a big business will rent a space with capacity to grow. A small warehouse will go through more tenants more often because they're smaller, medium-sized businesses. Funnily enough, if I buy you a really good business, a really good property that's got a solid business in it, they're probably going to leave in the next 5 years because if they're doing really well as a business, guess what industrial businesses do? They upsize.
Yeah.
They run out of space. So weirdly, the better I buy the client, they're probably, and that's where a lot of people get caught up. They focus on the tenants so
Mm.
much with industrial. Um,
Mm.
so for the types of assets, and as I mentioned before, things like how many access points, percentage of office compared to floor space, do they have overhead cranes? Is it high roof ceiling height? Is there dual access? Can trucks turn around in front of it? All this comes into play doing comparisons. Whereas a three-bedroom house is a three-bedroom house. Yes, there's nicer ones and not as nice ones, but you've got that with commercial. You've got to look at the age of the building plus all that other stuff. So it gets complicated and you've got to spend a lot more time on it. But like I mentioned, three times the cash flow, exact same capital growth as well. So it's worth doing the work. Most people aren't though. Most people just want to have a look on real commercial, look at some
Yes.
pretty and go, oh,
I
this
was
looks
gonna
nice.
say that.
I should buy this.
Yeah, because see, I just have one question. A lot of clients they don't know how to do the due diligence, or they just they just see it as they just treat commercial as like a buying a residential. So what
Yeah.
happens if they don't do this due diligence? Should they still go ahead, or like should I like? But because we come across clients that sometimes we know that they don't do their due diligence. Yeah.
You you might get lucky. Like if you're buying in a good area, you might get lucky and be okay. And I'm gonna make up
Mm,
a number here. Probably 2 out of 3 times you're gonna be okay. But that
mm,
1 in 3 times, if you haven't checked something,
yeah.
actually, to put it in perspective, so we buy around 20 commercial properties a month for clients.
Wow.
Out of that, we actually crush 1 in 5 deals under the due diligence clause. So
Oh,
that's
wow.
us who we've got really good agent relationships that don't lie to us because we've done lots of
Mm,
deals in the past. Even those ones, so we've got trusted agents, we still crush because we find things that we're not happy with. So 1 in 5 we
mm,
actually crush. Probably 2 out of 5 of them, we need something corrected. And a lot of the times that
mm,
might be a price reduction because we find the outgoings, one part of the outgoings is not covered by the tenant. So the numbers, the net yield's wrong. We purchased at the wrong price. Um,
mm,
other things are things like the mezzanine floor isn't approved. So we either need to get it approved or get a price reduction or whatever it may be.
mm.
So, like I said, 3 out of 5, we're actually either crashing or changing the price or getting something fixed. And that should be enough to scare some people of like, okay, if
Yes.
professionals are having issues on 3 out of 5 they're finding, what's the likelihood they're going to get a good one? And you just don't know what you don't know. And I don't want to scare people because commercial is an awesome investment that you can do really, really well with. But do the work. I don't
Yes.
care if you don't use my services. Like I said, on my website, I've got the due diligence checklist. My course goes through step by step of all this information you can see on the screen, how to get it, how to cross check it, but do the work. Spend the 30 hours doing the work.
Yeah.
Before we go under contract, and this is probably worth mentioning, is most commercial properties are subject, unless you're buying at an auction or going unconditional, they're subject to due diligence. So you go under
Mm,
contract, subject to due diligence. then the agent will give you all the information because you'll get rental ledgers and P&L statements and the air conditioning service contracts. And we get
Mm.
a Dropbox with about 100 files. So there's
Wow.
quite a lot that you got to cross check.
Mm.
After this, if we've got time, I can even show you a due diligence report, which might actually help people.
Mm.
To do all that work prior to going even under contract, subject to a due diligence. There's probably around 4 or 5 hours of initial due diligence just to make sure you're getting the price right and that you're going to be happy with that area. So, like I said,
Mm.
a lot more work involved, and this is why, like, we've got clients like that have bought 20 plus properties through us, and ones who buy 15. We did a 27 mil property for a client, and they're very smart investors, but they just don't have the time. Like to
Yes.
be a high net worth individual, paying me a fee is cheaper than them doing it
Yeah.
themselves. So they
Wasting,
pay
yeah.
for this.
Spending
Same
time.
as I'm a mechanical engineer. I can fix my own car. I don't fix my own car. I let the
That's a good
service,
point.
and I pay them a fee to do it because they're better than me and they'll do it in a third the time. So,
Mm.
but I want to just take away, don't let this scare you. Just make sure you actually do the work. There's quite a lot more to it.
Yes.
Um,
Yep.
all right, lending and finance, the fun one, and this is, to be honest, one of the biggest. No, in all seriousness, this was the biggest advantage to me personally in my
Mm.
portfolio
Mm-hmm,
because
mm-hmm.
when I hit my servicing, and just to give you a bit of background, like I said, I had 9 residential properties. Then I actually went through a divorce. So
Mm.
I obviously like my income effectively half, my servicing income. Then I just started a new career as a buyer's agent. So I went from a couple hundred grand as an engineer down to 50 grand as a buyer's agent. Then I couldn't
Wow.
for a couple of years. Then I went out on my own 4 or 5 years ago. And again, when you start a business, banks don't want to touch you. But commercial lending let me keep going. So I was kind
Yeah.
of forced to it, even though I loved commercial back then, I was buying commercial for people. This is how I built my portfolio with these circumstances changes. But I won't take your limelight away. I'll let you comment over maybe the
Thank
different
you so
types of.
much, Steve, for such an amazing segue. So, I will just touch on because since we're on this screen, I will just touch on, as you can see here, we do in commercial lending. There are quite a few creative ways. There are quite a few pathways that can help a lot of clients. How do you say? It's all about strategic lending when it comes to commercial lending because there's different structures, different type of pathway. That just you can see here there are 5 types of different type of loans that we can do. And but I just want to give you guys like because some of you may not have a commercial loan and just have a loan. If you can go to the next slide, Steve. Yep. So let's just look at the whole commercial lending overview here first. As according to the Australian Bureau of Statistics, you can see here it's quite a stable line, but there's a peak during COVID time. That's when I remember during that time I was like writing a loan every week. I have a client buying a property every week for commercial lending during the COVID time because interest rate was so cheap and everyone just want to get into commercial space, even though they don't know what's good or what's a good commercial property. They just want to get into commercial property game. And then it dropped again because of interest rate hike. But as you can see, it's now slowly getting back into what during the COVID time. And like I believe like Steve can explain better in this. Like he can see throughout the trend for the past 10 years that the commercial property game is increasing, right?
Yeah, I'll touch on a point for that because that actually is important. And we spoke about this actually prior to jumping on, and we were saying like what's shifted in commercial.
Yeah.
Awareness has shifted in commercial dramatically. So, like I
Yeah.
mentioned, I released my commercial book around 5 years ago. It was the first commercial book on the market. There was no podcast series, books in the market. If I had a chat with someone and mentioned commercial, they were blown back. Their hair was blown back when I said, "Oh, the tenants pay all the outgoings." And I was explaining every little piece of commercial because no one understood it. Now there's
Mm,
4 or 5 commercial books in the market, 10
yeah.
podcast series. People like me, there's other competition out there. Like the awareness has changed dramatically. And funnily enough, this is where the hard thing is to get the data to back it up.
Mm,
That actually is increasing demand. So 5 years ago, the only people buying commercial were like people on the industry like me. A lot of my clients at the time were business owners,
yeah.
and they understood it because they were renting or a space or bought a
Yes.
warehouse or whatever themselves. They got it. They were like, "This is awesome. I'm getting awesome rent." So they were buying. Outside of that, everyone just was scared of the mess and wasn't buying. Now I've sold 50,000 books just myself. So there's 50,000 extra people just from little old Steve looking at commercial. They haven't built any more commercial. So supply
Mm,
and demand, all of a sudden, I'm making up a number here. let's say there's an extra 500,000 people in Australia all looking at commercial now, where 5 years ago there wasn't. Which is also, and why the heading of this presentation is why one of the reasons it's going to be the best performer in the next 5 years is there's just so many more people looking at commercial, but the
Yes.
stock's not there. And that's why the vacancy rates
Yes.
have dropped. And I hand on heart think, especially industrial and suburban retail, especially, is going to far outperform residential in the next 5 years because of that
Wow.
demand.
I agree. Yes. Yeah, because I have a lot of clients are always searching for properties and they just keep saying to me, "Oh, not enough stocks in the market." So, yes. And and when we move to this next slide, it's just a basic comparison between a residential loan and commercial loan. As Steve has touched a little bit on this, residential loan is a standard, buying a property, buying a house under individual name, primarily go to a bank, and then although you can lend up to borrow up to 95%, but it's mostly most people still buy like a residential property under their individual names. But when it comes to commercial, the biggest differences are, the loan term, LVR, and the interest rate. So commercial, generally you can, is the borrowing amount is 50% to 70%. But in some cases, we do 100% lending, but of course, it's case by case and there are extra security, things like that, or depends on the lender as well. Um, and also, when it comes to commercial lending, there are a lot of different pathway that we can do. Full dog, lease dog, just based on purely the lease agreement, which is that's a lot. That's what we do a lot these days. People just want to get the rental income, don't want to provide any other financial because they may have other commitments, under their individual name, and yeah, and also that's what one of the lease dog, and we have no dog loans. There are lenders that do no dog loans these days, so there's just a lot more options for clients when it comes to commercial lending. And then we go to actually, I will just quickly answer one question because I think this is relating to commercial lending. It says here like there's an audience that asks, do you use different entities for each commercial purchase? So meaning one trust under one corporate trustee for each commercial property,
Mhm.
expecting they want to purchase more commercial properties down the track. So we do see when it comes to commercial lending, we do see a lot of clients have different SPV setup or different trust setup for different like for each of their property. But there are some clients that just buy under all just one trust. All it comes down to is the strategy. Speaking with professional like Steve, then talk about their long-term plan. What's their plan? Are they planning to like the retirees, or are they just in the property growing stage? So it also works with your accountant as well to find out we all work together as professionals as a team to help you uh, do a strategic lending so that we can maximize your lending portfolio and your property portfolio. So yeah, for this question, Steve, do you have any advice on this? Like, do you suggest clients to buy one property under each SPV,
Yeah,
or just
really good question.
yeah,
So I'll touch on a few points. So
mm,
buying entities for commercial and residential as well comes down to three things. So the first two ones are the ones that everyone talks about. So the first one's tax minimization. Like
yeah,
the only reason you're buying under different entities is you're trying to save on tax. Like that's the purpose of it. The
yeah,
next one, which people know as well, is asset protection, because if you're in a lot of doctors and things like that, for instance,
mm,
the chance of getting sued is quite high. So they're doing it for asset protection. Um, and that's where when you got the tax minimization one for the number one is
mm,
that's where people buy in a trust, because as you know, you can disperse profits to beneficiaries. There's some good
yeah,
tax effective. You pay company tax rate. So if you're a high income earner, it makes sense. The one that's rarely spoken about, and you touched on it quite well, and I think I want to emphasize a little bit more, is borrowing capacity.
yeah,
So people don't, your accountant generally won't talk to you about that. But if it's an investment savvy accountant, and this is why you ask like me or Jocelyn for a recommendation, this is where I think the question was leading to about buying under different trusts. So
yeah,
what the premise of that is, if you buy different commercial properties under different trusts, and your accountant signs off that that company is a or trust is a profit making entity, i.e., the rent is coming effectively in the green for tax, it won't be regarded for the next purchase. So you can then theoretically infinitely buy commercial properties without worrying about any servicing issues. That sounds good on paper, but because you're buying these assets with 30 to 50% deposits, that's the bottleneck. And the bottleneck is
Yes.
coming up with a 50% deposit. That's the hard thing. But be mindful of your lending. And again, this is why you talk to a good commercial mortgage broker, good commercial accountant, a good commercial buyer's agent, and come up with a team strategy.
Yeah. We actually, yeah, so we will just go through our presentation, and because we do have quite a few questions as
Oh, brilliant.
well. But I think that they're regarding in the overall, yeah, so because we're just gonna go through our presentation first for everyone. So as you can see here, I just want to touch base on this quickly of the key criteria that the lenders are actually looking these days. So if you look at, like, of course, we are in a high interest rate environment, so a lot of lenders, they are more look conscious of, what's the leverage. But if you can see, I want to point out one thing is the location and the asset type. Those are the key criteria for the lenders actually. For compared to last year, most lenders are not so big on location. It's okay. They're more big on the asset type, like what type of assets. Then it will determine how much they can lend. But now location really plays a key role. As you can see from the for the first half year of this year, the lenders are now looking at the asset type and also the location. The location will play a key role in this. And also, like, the borrowers are now sticking in regards to the leverage is always quite high, quite important, because borrowers are now looking for, okay, what's the lender, which lender can lend them the most. Yeah.
Yeah. Yeah, one of the points to touch on here is lenders are assessing risk when they lend
Yeah.
to you. Risk for you as an individual buying the property, i.e., what property type is, which is the top one, the asset type. So they want to make sure it's a
Mhm.
really robust investment. The other one is the risk for them. So
Yes.
they actually balance their books based on where they're heavily geared, for instance. So if they've had lots of people in Sydney go buy office space in the last 5 years, they don't want to keep building their book of office thing because if office has a tumble, they're too
Yeah.
highly leveraged. So they're kind of matching up both of those. Most of them are doing what I do anyway. So I've actually got 3 qualified valuers in my team. So we're doing this internally anyway, because we want to make sure we've got a good asset in a good location with a tight kind of tenant with versatile premises with a tight vacancy rate. So we're kind of doing this anyway. The asset type is a big one. So they don't like certain types. So for
Mm,
instance, like office space at the moment, a lot of lenders don't like office space
yeah.
because vacancy rates are about 17, 18% in most capital cities. In saying that though, that's not me saying don't buy office space. I actually think there's some bargains to be buying office space at the moment, and you can get some incredible yields. We're buying 7.5, 8.5% net yields, but you've got the vacancy to worry about. To get around that, we're not buying CBD office space. There are opportunities if you're a very high net worth individual of buying whole
Yeah.
floors and things like that and
Yeah.
subdividing them up, and we can go into that a little bit later. But I really like suburban office spaces, ones just on the fringes of like the Northern Beaches and Chatswood. I'm talking Sydney because I live there, so it's a bit easier. But you buy the smaller buildings. So you buy the little building where there might only be, say, 6 to 12 office spaces in it, because then you still get the land component. And as long as the zoning's correct and there's like residential around it, you can't be oversupplied. So as long as when you talk to town planner, they're changing the houses into medium density. So say they start building apartment blocks and townhouses, the population is going to grow. So if you're in an area and over the next 10, 15 years, the council has planned for 30% population growth and you've got an office space, that vacancy rate's going to come down. Whereas if you're
Yeah.
in a saturated CBD market, they can't put any more people there because developers have stopped building high-rise apartments. So the
Yeah.
vacancy is going to take a longer time to come down. We can talk about COVID and like there are people going back to the office. So I actually do envisage the vacancy rates to come down from maybe 17 to around 12, but that's still quite high considering you get industrial for sub 2%. So it's just
Mm,
balancing those types of factors.
yeah. Yep. So we just quickly go into the next slide. Yes. So as you can see here, this is something that I find it very interesting. So I saw this chart last year. It's actually when it comes to non-bank versus banks, the percentage is actually quite even. But now this year, this data is this for this year, and now the non-bank is half the market. So a lot of people now, they're just happy to pay slightly higher premium just to get more lending, because because they have a plan. They have a plan that they know, they can see the cash flow. They're willing to pay just a little bit more just to get a good asset, and they just want to get into the commercial property space, and then they know that the cash flow will be able to cover. And also the non-bank lenders, they also see the potential, and then they are willing to lend more because they have more appetite in regards to this space. And also the non-banks also cover for developers. They're always looking to borrow the max. Yes.
One of the points I want to touch on there, Jocelyn, is when you're buying a commercial,
Yeah.
yes, you need to be mindful of interest rate, but be aware you're not on the interest rate forever. People look at it
Yes,
and go,
that's
"Oh,
right.
I'm going to be paying 6.5% for the rest of my life." This is just my personal strategy as well. So I used to buy commercials. Now I do it with a 50% deposit because I've got a quite aggressive pay down strategy. But prior I used to get
Mm,
70%. Get it
yeah.
however lending I could get. I'd go to a second, third tier,
Yeah.
fourth tier private lending. I'd get the money and pay a high interest rate, a 7.5, eight
Yeah.
and a half percent interest rate. But get that asset, I knew it was a good asset and pay it down over the few years. Get
Yes.
it
And
down
then
to
we can refinance.
50%.
Yes,
And then you can go refinance and get a really good sharp interest rate,
that's
or even
right. That's right.
go across to full doc lending and
That's
get a
right.
really sharp interest. So don't think it's forever. What I do is
Yeah.
when we're planning, we plan for the worst and hope for the
Yeah.
best. So when
Yes.
I showed you that cash flow spreadsheet, we go up
Yeah.
to 9.5%, we go down to 2.5%, and we go,
That's right.
can we afford this price range? If the answer is yes, yes, you can mitigate some of the risk.
Yes, yes, that's what I was gonna say. Very thank you so much for reminding me, Steve. Like, so a lot of cases that we go to non-bank, we don't expect clients to stay there for forever, like 20 or 30 years. No, it's not. Like basically like 2 years when they pay down a bit and they're comfortable, like down to 60, 70%, we always want to help them to, save more money on the interest rate to refinance to a bigger bank, and then they will start looking for the next one. So yeah, it's all a cycle, and then just to help them to have a strategic landing place. Yeah.
Yeah, well, one of the other things that a lot of people don't talk about is you need to assess where you are in your career as well, because most people, unless you're 60 years old, most people in club 30, 40 are going to have some sharp professional increases in their salary. Like most
Yeah.
people looking to get manager and do things. So you expect actually you might have 20, 30% extra increase in the future. So surviving now is the key. And then when you get those,
Yeah.
then things become easier or you expand the portfolio. So this is all part of the plan of like, point out we work with a lot of, same as you guys, a lot of doctor clients.
Mm,
Their strategy is completely different because if you're talking to a registrar, what they're going to be earning in 5 years time is it's chalk and cheese. They can go from $200,000 to $1 million. So
yeah.
what you get for lending now is irrelevant. It's just get them into the market for their budget and move from there. And this you gotta like map out all these layers together.
Yeah. Thank you so much.
Let's move
I think
down next
that's
slide.
next year.
All right, so
Yep.
this is back to me. All right, so this is what I've touched on a few times about value add. So just to recap, you can do all the same residential stuff. You can renovate, subdivide, do all that. When I say subdivide, it's slightly different because you're not just like, yes, you can knock down and rebuild multiple warehouses or retail, but you can do quite a lot. So like I've done changing the property's use. So what I mean by that is different types of commercials will rent at a different rate. So if you've got a market where let's say the square meter rate for office is higher than industrial, and you own a big industrial building, you might, instead of having a 20% office space, 80% floor space for industrial, you might actually build a mezzanine and actually increase the office floor area to 50% or even
Yeah.
100% in some cases, because you're going to get more return on your investment, which will value the property more. So just changing the type of property is going to give you different rent, which you can't do in
Yeah.
residential. You can't change the tenant and get more rent. The closest thing you can do in residential is convert it to a commercial premise. So when you have a house and it's like a vet or a GP clinic,
Yeah.
but
Like
that's,
medical.
guess
Yeah.
what? That becomes commercial as well. So that's
Yeah.
the balance in there. Similar for number point two is create multiple tenancies.
Mm,
Typically, what happens in commercial is smaller areas will rent for a higher square meter rate. So, what I mean by that is if you've got a small warehouse, you might get, say, $300 per square meter, whereas a really large warehouse in the same area might be 200 per square meter because they're renting a bigger space, so it's sort of discounted. So, if you've got a big warehouse that's got two or three roller doors, you could theoretically build a firewall between each of the roller doors, split it into three tenancies, and you'll get
mm,
33% more rent come in, which
mm.
values the property at 33% more. So all of a sudden, just by building three walls, I've now got 33% more rent and the property's grown 33%. Just by something
Wow.
simple like that. That sort of flows on to the raising and lower the rents. So a lot of the stuff we
Mm,
is basically like you get something that's on the lease and it's under rented. So we did one a couple months ago where we bought it about a 4.5% net yield. And then as soon as the lease came around, we bumped up to market rent, it jumped to a 6.5%. So all of a sudden, we have literally had that property grow by about 50% because the rent's effectively gone up 50% by doing nothing, literally just letting the piece of paper go out. The hard one with that one was getting financed because lease stock was off the
Mm,
table because the rent wasn't quite there. So we needed
mm,
stock with a large deposit. So like I said, I don't want to sugarcoat. There's always a negative to doing some sort
yeah.
of strategy. Um, Increasing the floor area is one I can't remember if it's actually on this one or not. No, I haven't noticed it. So increasing the floor area is actually a very easy one as well. So we'll typically do this with say like an industrial property. If you build say a mezzanine area, so you've got your 1,000 square meter floor space, and you build a mezz floor, which basically is some steel beams, and that costs most of the time on our stuff we do is about 80 grand to 120 grand. You can increase the floor area by 20 to 40%, which then they pay for that floor area because that becomes workable floor area. And
Mm,
again, you've now got more rent, which therefore translates to more capital growth. Oh, sorry, more capital because it's actually worth more. So you can
mm,
in kind of multiple ones. Um, Creating new sources of revenue is actually an interesting one. So that's where you might rent things, let's say, off peak. So I've got a property, it's like a big freestanding cafe. I actually rent that out after hours, sometimes to functions and things like that.
oh,
So multiple there. A lot of ones we actually get sometimes is office space where
yeah,
its usual tenant and you make an agreement with the owner saying, hey, after 6%, can a tutoring school come
yeah.
in, rent the space? And so you have off-peak renting as well. Um, the new sources can be simple. I'm going to show a funny image later. We've done advertising space. So we did a billboard space on one of our Perth warehouses, which brings in 100 grand a year extra rent.
Wow.
So that's a very easy way to get 100 grand is you pay.
Yeah,
Funny enough, the company you don't even have to pay the actual company. Um, you can actually they will actually do it. They'll actually install it, and they'll basically lease the wall for you for $100,000.
wow.
So
That's
that's
a
one.
true passive
Um,
income.
yeah, ATM machines. Here's a good one. We bought a property in Brisbane for $3 million. So it's a warehouse, but it had like four tenancies. We had Optus come in and rent the roof space, and they gave us a 10-year lease at 100 grand per year. So that client, they got it paid up front as well. $1 million up front for someone putting telecommunications on top. So you get that. There's other things like we've bought like petrol stations and increased like a dog wash station, and there's all these really cool creative ways you can do it. So
Yeah,
um, you've got all that fun stuff that you can't do in residential.
yeah.
Um, some simple ones, and I'm going to cover probably the last like three or four in one
Mm,
go. So getting a stronger lease or longer
mm,
lease, or changing the tenant actually can
yeah.
change it as well. So what I mean by that
Mm,
is if you get a blue chip tenant in, people pay a premium for that. So where the area might be a 6% cap rate, which is 6% net yield, if you got like let's say a pet barn or a medical tenant in, that will serve at 5%. So you all of a sudden
yeah.
got 20% extra because you've changed the tenant. Having a really long lease, if you get a property with
Mm,
like a 5 or 10 year lease where primarily it's on 3 year, that's
yeah.
worth
Thanks,
more
love
as
it.
well. Yeah, that's
Yeah.
right. Banks love it. You can get lease stock loans way easier. So you can
Mm,
increase it that way. The stuff down the bottom mainly applies to retail. So like removing underperforming tenants. That can be like if you've got like I personally own a whole shopping center. If you get rid of some bad tenants, and that bad tenant can be they don't fit in with the mix of the property.
mm,
You want complementary tenant mix, for instance. Like if you've got a GP clinic, getting a pharmacy next to that is perfect. They complement each other. They bring foot traffic each. They serve each
yeah.
other well. I personally, I've got in one of my shopping centers kicked out my tobacconist. And because it's next door to a hair salon, we've actually put in a nail salon. So
Oh,
they complement. Now people go and get both. So they come.
yeah.
So now they've got weddings and they can advertise together. It brings more foot traffic. So getting that stuff right is quite powerful.
Mm,
Property management, similar to residential, a poor property manager can kill your net income and your
yeah.
vacancy rate because they don't know how to advertise. Same thing for
Yeah.
residential. Like you get a bad one, they just don't know what they're doing. It just causes dramas there. And then finally, development. We buy a lot of sites where we buy a freestanding retail or industrial property,
Potential.
and we
Mm,
build extra warehouses or extra tenancies or increase the rent that way. So there's all these
mm,
cool things you can do. One of the ones I want to show you. So this is in Concord in Sydney. I actually was going to the physio across the road coincidentally, and I walked outside and went, "Oh, that's interesting." It's a fish and chip shop with a
mm.
residential property on top. There's an ATM machine on the side, and it's got telecommunications on top.
Wow.
So there's four sets of income coming in this small little building.
Mm,
I don't recommend living under telecommunications towers. Just FYI, like I'm not
yeah,
endorsing that, but just I'm just in my head was like they probably bought this property 10 years ago, and now
yeah.
it's generating them $200,000 income. Like
Wow.
it's just and this like I said, there's all this cool stuff you can do. Feel free to
Mm,
go on my website as well. There's like you can see our Eureka's acquisitions where it's got like the billboards and telecom and
mm-hmm,
ATM machines and all that stuff. We help you with that, obviously, if you're looking to do a value add. Personally, all my investments, I buy bulletproof, boring assets. And people find it
mm,
funny that I've got a whole team. I've got 20 people in my team looking for properties, and I buy the boringest properties you can pay, which I'm actually going to go into a little bit after this. Before that, we'll talk about the hotspots. But I'll go into my personal investment and why I bought a boring
mm,
property and overpaid. The hotspots is a hard one because it depends
mm,
what budget you have, what you're looking at, and where you're looking at. So what I want to touch on is if you're looking for big data, some of the
mm,
big players in the industry like CBRE, Savills, Knight Frank, they've got
mm.
good quarterly and half yearly reports. So
Yeah,
you can just type in CBRE industrial report 2025 or 2024, and there'll be PDFs that come up, and it'll
yeah.
give you the areas of where the vacancy rates are, what the square meter rates are, what the industry is doing. Word of warning, that's why I've got the beware on here. It's only doing it for the big premises,
Yeah.
3,000 square meters. So just because it says this area is really good, doesn't mean your retail, your little GP clinic or hairdresser is that data. But it's a good overall general indicator of if big industry is doing really, really well there, then the small industry is doing well. One of the little secrets we do is we buy quite a lot of properties that are surrounding Bunnings warehouses because of the foot traffic. You can go and inspect the property. Like some of those get 20,000 cars a year. Oh, sorry, a day into it. And some of them have
Yeah.
50 to 100,000 cars passing. If you have a little supplementary warehouse next to a Bunnings, you are always going to have a tenant because it's just
Wow.
exposure. And normally I'd say exposure is more important on a retail. That exposure,
Mm.
I call it industrial retail. So you like,
Yeah,
the
yeah,
showroom type ones where
yeah.
you want to be seen. That one is really important. Whereas with
Mm,
retail, for instance, the the data doesn't really mean anything, if I'm honest, because if you buy
mm,
a suburban retail strip, what happens in a surrounding, like let's say you go 2 kilometers away to another retail strip, yes, I will go look at what the vacancy rate is in that industrial retail strip. No, sorry, the surrounding retail strip, but the foot traffic and road traffic is completely different. Like it's
mm.
exposure, and we've all been to it. Sometimes you go to like a little retail strip and it's bustling. The
Yeah,
cafes are packed. There's thousands of people around. That one, you're like, okay, if I ever lose this tenant, I'm going to be okay. The
yeah,
other ones you go to, and even though they're all tenanted, they've got that kind of ghostly feeling about them. It's just like there's something dead around this retail strip. So on
mm,
paper, you can investigate and go, okay, they're both fully tenanted. One of them is still a better asset.
yeah,
Whereas industrial, you can make the decisions based off the numbers a little bit easier because most tenants don't care if they're around the corner or this, they don't want the street exposure. So vacancy rates are a bit more concrete. Similar to office space, like office tenants don't really care what building they're in compared to the other, assuming they're nice enough. And
mm,
it's not a prestige business like a law firm in Sydney CBD where they like certain buildings. And a lot of time that's for complementary things like where the courthouse is and things like that. But just a word of warning, like you can use it for general hotspots. To give you a bit of around the grounds, um, this is the kind of vacancy rates averages for industrial. Looking at last year, just the comparison between like the first half of the year, second half of the year. What I want you to kind of take away from it, don't worry about the numbers too much, is just what I was saying before about the low risk nature of say industrial. Like these are sub 2% in most capital cities, and
mm,
there's also markets within markets. So You don't look at the vacancy rate for Sydney when you're looking at residential. You look at your suburb. So going on from that, I'll just show you. It'll actually break
Mm,
it down per region of where you can actually
mm,
buy. So you can actually see if you go to the bottom left-hand corner, that's the Sydney one. And as I mentioned before, you can see 0% for North Sydney and the Northern Beaches. Zero.
yeah,
0.0%. And I live on the Northern Beach. So I live in a suburb called Freshwater, which is
yeah.
right next to Brookvale. And I
So
was
nice.
personally trying to buy an industrial property in Brookvale. There is nothing vacant. Literally, no
Yeah.
vacant properties. Again, if you go on Real Commercial, you'll see there's two or three ones that have been advertised, but they're not even vacant yet, or they're very small nook in the wall.
Mm,
Like I said, this is just for 3,000 plus square meters, so take that.
mm,
But the history for most of the stuff we look at, if you lose your tenant in these markets on a small strata based one, you're talking 1 to 3 months vacancy, which is
yeah.
nothing in the grand scheme of things.
Yeah.
One of the fun facts I used to actually calm residential investors down because they say, "Oh, I don't want to worry about a vacancy. If it goes vacant for a year, I'll be stuffed, etc." Look at it this way: if I buy you let's say, an industrial property and it's on a 6% net yield, and I buy you something with a fresh 3 year lease on it. So it's got 3 years on it. I've checked the guarantees. There's a bank guarantee on it. I've checked credit history, the person guarantee. So we're somewhat guaranteed those 3 years worth of rent because I'm getting 3 times the income compared to a residential. Theoretically, if that property went vacant at the end of 3 years, it could sit there vacant for another 6 years. Another
Mm,
6 years before I'm in a worse cash flow position compared to residential. So when I put it that way, think about your buffer. Like, yes, you're chipping out money out of your pocket every week with residential. If you save those 3 years worth of rent and keep that in an offset side account, you could theoretically survive 9 years before you're in a worse position. So like that's when you put it in second, that's why I said commercial have a long-term mindset, not a
yeah.
short-term 12, 24 month. Again, you need your buffers, etc.
Yeah.
But again, feel free to get all this data. It's readily available. Give me a call if you've got any issues when I can kind of point you in. But a bit of a run around the grounds. We're buying quite a lot of industrial and suburban retail at the moment. Not buying
Mm,
any like internal retail. So what I mean by that is like Westfields and stuff like
mm,
that where shops
mm,
are in. I want the land component and I want the street exposure because that brings versatility. That retail can be medical, it can be office, it can be an accounting or a law firm or a conveyancing office. It can be service based, it can be a hairdresser, dog groomer, or anything. So it gives me the versatility from that. So industrial, suburban retail. The bulk of what we're buying at the moment is Sydney, Canberra, Brisbane, and Perth,
mm,
because we're finding we're getting the best bang for buck. We're getting 5 to 7% net yields, whereas
mm,
Melbourne is quite hard to get a tight vacancy rate and a good yield. Adelaide yields are terrible. They're sub 5%. We still buy there. We still buy one or two a month there. But again, it's got to be the right asset. So it's just lining up what the client's trying to achieve, whether they're more cash flow driven or whether they're more capital growth driven. Some clients I mentioned as an example before about like you get the older clients, the 55-year-olds that are looking for the retirement fund. We bought an entire shopping center in Mackay, which is north, which vacancy rates are high there. But for a few $1 million, they got 8 tenants, and the tenants are blue chip tenants. It's
oh,
Subway, Gloria
wow.
Jean,
Yeah.
medical, pharmacy. So even though I'll argue, I don't think you're going to get as much capital growth there as say in
Yeah.
Brisbane, the hype of the Olympics and population growth. It's secure income, and we got that like a 7.2% net yield. So
Wow.
versus buying 5% in say Brisbane warehouse, I'm getting quite a lot more rent. So that
Mm,
offsets some of the risk that way. I'm also offsetting the risk by having lots of tenants because if one leaves, I still get 7/8 of the rent, for instance. So I'm still in a better position. But the argument then becomes capital growth versus cash flow. So again, it's balancing that. I've, like I mentioned, I've bought 2,000 plus properties all around Australia, every regional town. Typically, if I go regional though, there has to be an X factor. So blue chip
mm,
tenant, multi-tenancy, really high yield, because I want to take on the risk of having less industries
yeah.
with something that kind of gives it. And like some examples would be for a couple mil, we bought in Devonport in Tasmania about 6 months ago. That was a whole industrial complex with I think it was six tenants from memory. So you're getting six tenants at a high yield, mitigating the risk, knowing the full well that probably every year or two, one of them will go vacant for 6 to 12 months.
Mm,
But again, you've got it. So again, it's balancing that. We buy some blue chip stuff like McDonald's and Hungry Jacks and things like that, because most people can't afford $20 million in Sydney, but they can
mm,
afford $5 million in Bendigo. So that's
mm.
so there's always a pro and a con of each, like I've mentioned.
Yeah.
Yeah. Okay, so this is what I alluded to before about my property and how I don't necessarily like, even though I could leverage up to about 20 to 25 million dollars from asset, I'm not doing that. I'm going to buy two or three of these at around 3 to 4 mil each. And for
Mm-hmm.
me, it's about building a passive income securely so I can keep traveling, spend time with my 2 year old. But I actually overpaid on this property because I actually know the agent quite well. There was four other offers on contracts for this property. And I like that because it means if I ever decide to sell this property, I know it's a high in demand property and there's four other people
Mm,
who are willing to pay a similar price. So I actually paid around 75 grand too much. When my valuers in my team looked at it, they said, look, Steve, this is only worth 3.1 mil. But I was like, 75 grand, percentage wise, that would
mm,
be like buying $1 million house in Sydney for 1,025,000. Like, no one's going to gawk at that. So I was like, yeah, it seems like a lot of money, 75, but percentage wise, it's not. It's a couple percent.
mm,
However, this is actually the one I mentioned that we kicked out the tobacconist, and the reason
mm.
that is tobacconist insurance premiums are going through the roof at the moment because they keep getting firebombed. So the premiums have gone up like 15 grand. Like it's
Oh,
really
wow.
significant for a 30 grand asset. Sorry, a 30 grand rent asset. The tenant I replaced it with, which only took a month, by the way, is now paying 38 grand. So 8 grand at a couple of, I've actually made back that 75 grand. Actually, the property's increased in value by about 150 grand just because I changed the tenant and got a bit more rent.
Wow.
So remember I mentioned the value adds?
Yeah.
Changing tenant, increasing rent. Funnily enough, now that they're paying more rent, as all the other leases come off, that's the new square
Big,
meter rate.
big trend.
So
Yeah.
all of them going to go up at 20, 30%. So all of a sudden, like I said, the purchase price, even though as a buyer's agent, I want the best buy for myself and my clients, isn't actually the factor. You want to make sure all of
Mm,
the reason I like this deal, freestanding, it's in Brisbane, it's next to a major preschool and a major public
mm.
school. So it's got heaps of road traffic, heaps of people kind of
Yeah.
park, get their coffees and do their services before their kids. Um, and in the last 10 years, I went through the whole complex to look at the vacancies. It's only had two vacancies in the last 10 years, and the longest
Wow.
period of vacancy was 6 months. So
Wow.
pretty low risk. I've got eight tenants and a big, if this, the site's 3,500 square meters. Pretty low risk. If I lose a tenant, 6 month vacancy, get another one. Comparably, I also was looking at another retail strip that I could have got. This is a 6% yielding one. I could have got another one for 6.5%, but it was only about 1,800 square meters. So it's the one where have on the main road, you have the straight line and then all the car parks perpendicular. That would have,
Mm,
if I spent the same, I would have got an extra, what's that, $15,000 a year rent. But I'm playing the long game with this because now I've got 3,500 square meters. Houses across the road sell for around $950, $950,000 each. I could chop this up in the future and build 10 houses
yeah.
and sell them off for $1 million each. So all of a sudden
Yeah.
I've got development options and I've got multi-tenancy, got low risk. So this one is just a good set and forget low risk. Next purchase I'm looking at the moment is probably a multi-tenancy industrial or a blue chip
Mm,
tenant. And I'm just, like I said, going to buy two or three of these, and that's going to give me, I've got a pay down strategy. I'm using 50% deposits. It's going to be 500,000 passive income just from a
wow.
few assets, just from two assets, 500. This is not including my other portfolio. I own other
Yeah.
commercial properties, and things like that, but this is just low risk. While business is doing well, while I'm young and healthy, let's pay down. So again,
Mm,
I don't want to have a 100 bill portfolio. I just want the passive income and lifestyle.
yeah.
This is what I'll show you. I kind of showed you the other one before, but just to put in perspective for this deal, 3.175 mil, and it's around a 6% net yield. I get 28 grand depreciation on the property as well. I've actually got a lower interest rate. This is what I got. I bought this probably 6 months ago. I'm now getting 6.3%. That's coming down already. But put in perspective, because I did a 50% deposit, already it says 87, it's actually about 100 grand, but I'm just being conservative for the rents. It'll actually pay itself off in 7 years time, and I'll be close to a 250 grand passive income from buying one $3 million asset. And I
Wow.
want to reiterate, if I went and bought a $3 million house in Sydney,
No
that's
chance.
oh, it's 30 years of you doing P&I. Like
Yeah.
it's, and you still won't end up with a 250 grand passive income. So
No, no way.
this is really powerful stuff for people who want to retire in 10 years time. And I'm not going to
Mm,
retire. I'm very, as you know, energetic and I want to keep doing things. But I find when you don't have to work, it makes work more enjoyable. You definitely
yeah.
don't definitely don't skip the kids' events and do all that type of stuff because you're not chasing, you're trying to build something more bigger than money. You're trying to like
Mm,
kind of thing. So again, just me personally, I find passive incomes make my work day enjoyable, even though I work just as hard.
mm,
If you want to go to policeproperty.com, we're actually quite sharing with our information. We post about 4 deals a week almost on there. Just
mm.
to cover, and if you click them, you can go through and say, like, we buy like whole industrial complexes, little cheap retails, shopping centers, warehouses, Yamaha warehouses, and things. So you can get a bit of a thing. Like I said, the one down the bottom right, I really like retail showrooms. So that's the whole strip. You could theoretically buy one of them, but that's the industrial one where it's got a front showroom. The reason I like industrial showroom is you get two uses. You can be entirely retail. So an
Yeah.
example would be, like a fantastic furniture or a furniture
Yeah.
store. The whole floor is floor stock, so it's retail, you walk around. It could be a repco where the first third of the building is a retail showroom, and then the back half is the stock where you go and you get your car parts and things like that.
Mm,
Or it could be a completely like industrial one where it's just like a little shop counter at the front, and then the whole back of it is industrial. So it gives you really good versatility. There's some of them have got like CrossFit gyms in them, and other ones have got like
yeah.
we bought one with a swimming pool in it. It was for little kids swimming. They had
Oh,
three swimming pools built in it. So really good versatility with this stuff.
mm,
So I like retail showrooms, so I just want to touch on there.
yeah.
Uh, this is one I want to kind of bring in. I get asked this quite a lot. How are we going for time? I can keep talking.
We actually a bit over time, but
Okay.
and we have a few questions,
Um,
but
well, I'll give this a 30-second overview.
okay.
I get asked this all the time from people, especially for self-managed super fund, is business owners
Mm,
whether they should buy a premise for themselves
oh
or
yeah.
an investment property. There's advantages and disadvantages to it. So maybe we'll release these slides and people can have a read. But
Mm-hmm,
the
mm-hmm.
main one, it depends on the type of asset you're buying. So I would probably argue, just to summarize, I normally could talk about half hour on this, but I'll give you the summarized version. If you're buying an industrial, I'd probably say there's some really good tax advantages and it's a really good asset class and it protects you as well. If you need to be in that location, because vacancy rates are so tight, as I showed you before, North Sydney, you
Yeah.
don't want to be kicked out by your owner and then as a business owner not have somewhere to rent. So that's actually a risk mitigation for your business. If you're talking about buying an office space because it makes a bit more tax financial sense, probably not, because if vacancy rates are really large, you get more versatility by not owning, because if your business expands and you want to move to a whole floor or a different space, you've got that, and you could put that money into a high yielding, lower risk asset. So it always comes down to the type of asset, why you're buying. Is there a difference in yield? Do you need that location? Like a retail shop front. If you own a medical practice, owning that is very crucial because that is your bread and butter and how you make money.
Yeah.
So again, tying in all these, I won't keep talking, but to having a look at these like positives and negatives. But
Yeah.
again,
It's really
have a
good.
chat with your mortgage broker, have a chat with a buyer's agent or a property strategist, and then work out what's the most tax effective, what's the most protection for your business if required, and what's going to yield the best. One of the simple
Mm,
ones I do is like a lot of my Sydney ones will come and they'll say, "Oh, look, I want to buy a warehouse. It's 3.8% in Sydney." Which is typical warehouse in like a good area, like an Alexandria
mm,
or Northern Beaches or wherever it may be. I could go out and buy them, say, a 7% yielding asset in Mackay, like I mentioned before, a whole shopping
mm,
centre for the same price. I'm getting pretty much twice the rent. So they
mm.
could theoretically rent somewhere twice as nice for their business, which might actually increase business
Ah,
income because all of a sudden, instead
yeah.
of being 2 streets back from the main road, they're now the industrial showroom on the main Parramatta
Yeah.
Road, getting hundreds of thousands of exposure. So their business can actually increase by them not buying the premises. So there's all these nuances you need to kind of look at. But yeah,
Mm.
I'll, Um, quick one to finish off. When most people are going to ask when commercial is right for their portfolio.
Yeah.
I answer this by saying when it's wrong for you. So when it's wrong for you is when you're too early on in your portfolio journey and you've still got borrowing capacity, i.e. we can still leverage
Mm,
up to 90%, 100%, 105%, use parental guarantees, all that type of stuff. If it doesn't suit your risk profile, so i.e. like you're in an industry that's you can't build the safety buffer. You're in a high risk job that's like we get a lot of sports people where like we really need a pay down one, and because their income's going to fluctuate. The other ones you don't have the savings because like I mentioned before, you need a big deposit. So you need a 30-40% deposit typically. You just don't
yeah.
have that. So your money goes further with a smaller deposit. So you can't get into a good quality asset. And then the last one is you don't understand commercial. If you're not willing to
Yeah.
do all that work, I said before with due diligence, don't bother. You can still do really well in residential.
Mm-hmm.
But it's right for you if you're genuinely looking to increase your servicing and keep buying properties and you're out of servicing residential, it's a good option. If you're looking to build a passive income more so than leveraging for net wealth, or you're a business owner and you don't have leverage because you're on paper you're not really wealthy, but for taxman because you're hiding a lot of your income, the different loan types of lease stock and low doc and no
Yeah.
doc are obviously
That's
quite
right.
powerful, because you're not
Mm.
disclosing a lot of the information that you have. So they're the kind of general reasons why you actually might buy commercial. And that's it.
Ooh.
That's my presentation.
Thank you so much, Steve. So I will just we have quite a few questions. I would just I'll just read them out. So okay, so this one is asking what's a good amount of capital to start investing in commercial?
You There's two things. You can buy a car park in Sydney CBD and get an 11% net yield for $80,000. To be
Mm,
serious though, 200 grand is probably the good starting point. Because
mm,
leverage that can get you say a 500, $600,000 warehouse or retail shop front. As
mm,
you move up in price though, you start to probably get a little bit more secure assets. So one of the points is people go, I can buy a fantastic 500 grand commercial industrial property, for instance. My brother actually, that's his strategy. He buys lots of small ones as opposed to one big one
mm,
because he gets to diversify. Like he can buy one in Perth, one in Brisbane, a retail shop front, a little medical center, and he diversifies by location and asset type.
mm-hmm,
However, they're not great for lease stock loans because good luck trying to get a $500,000 asset that has a 3-year lease on it. So they're
yes.
typically 12-month, 24-month. The negative of the small ones are they're smaller businesses. So they're going to come and
Mm,
go way more often because like average Joe's electrical service is either going to struggle and close shop every few years or is going to
yeah.
grow business. So you cycle through the tenants. However, the vacancy rates are really tight on those. They normally take a month or so and you get another tenant in, but the property management costs erode a little bit because you've got releasing fees and things like that. Whereas as you start moving up into say the 1 mil to 2 mil, you start getting longer leases, more
Yeah.
established businesses, blue chip tenants, more value add opportunity. You then explore lease stock. So those you probably need 350 grand plus to get into like a 70% loan to value ratio commercial.
Mm,
Then as you keep moving up in price, the deals get more exciting. So what I mean by that is you start looking at entire shopping centers, multi-tenancy
mm,
industrial complexes, lots of value add opportunities, blue chip tenants like the McDonald's and the pet barns and all that type of stuff. You start seeing more creative deals. So that's the kind of spectrum of properties you look at.
Yeah, I think you answer one of the other questions as well because there's one audience that asks, when it comes to commercial properties where the price, a small warehouse like 400, 500K, do you still see both strong rental yield and capital growth potential for smaller space, or they typically come into play with only higher value properties?
You'll theoretically get the same capital growth long term as a slightly
Mm,
larger one because a let's say 150 square meter warehouse, if a 250 square meter one, for instance, doubles in value, that one doesn't stay at the same value.
yeah,
They have to remain proportionate. Funnily enough, in the last few years, the smaller warehouses have had more capital growth because there's more investors looking in that price point. So when I mentioned, you know how I was mentioned rental yields increasing, that gives
yeah,
you
yeah.
capital growth. You've also still got cap growth compression. So what I mean by that is you get capital growth with nothing changing. So just a minute, that's basically residential property. Residential property, it can grow because there's more interest. It has nothing to do with the rent. So where we're buying stuff a few years ago at 6.5%, now you have to pay 5% for that smaller asset because there's
Yeah.
so many more people trying to buy it. So we've actually had more capital growth in the shorter. Long term, it's going to even out. But to answer the
Mm,
question, same capital growth. The biggest question I want to touch on this, I always get asked, people say, oh, what price point do I start buying where I can start buying well? And what they mean by that is they
mm,
want to get out of all the other mum and dad investors and have less people looking. But jokingly, I always say, why do you want to buy an asset that no one's looking at it? Like
yeah.
if I'm buying a residential house in Sydney, do you want 100 people turning up to the open home or do you want one person turning up? So but what they're saying by that is by having less people looking at it, you might be able to pick up a bargain and there's a bit more
Mm,
negotiating about, which is true. But as I just mentioned on my one, I bought the one where I had four other people because that indicates short-term capital growth.
yeah.
But that's why the smaller ones have grown so much because there's so many people in the self-managed super funds just looking for a
Yeah.
little nest egg kind of thing.
Yeah.
And to be honest, the difference between let's just say a $500,000 industrial property at a 6% net yield, that's 30 grand rent that you get from that property.
Mm,
Drop to a 5% compression. So it's now 5%. Instead of getting 30 grand, you're now getting what, like 5 grand less. So it's 25 grand. So in reality, it's not life-changing money. So you can still pay that little bit of a premium. Typically, what's going
yeah.
to happen next rental increase because they're in demand, it's going to bump up 5 grand and you're back at square one anyway.
Yeah. Yeah. Thank you. I think that's good. Yeah, so we have these two questions I think you can answer in one go. It says, what area or sector of commercial property do you see safest growth? And what do you foresee in the next 12 months in regards to asset type?
Yeah. So industrial's the safest for most people
Mm,
because it has the tightest vacancy rates out of all the
yeah.
assets.
Mm,
It
mm,
also is the easiest to understand with data because,
mm,
as I
mm,
touched on before, comparing, you can actually get a square meter rate for rent, and then like in a big industrial complex, no one
mm,
really
mm,
cares what one they're in. Like, so you can use other ones as a comparable. The adjoining complexes, you can use them as comparable. So you get some confidence in the numbers. Whereas retail, different game. It's suburban, it's foot traffic, road traffic, and that. So industrial's the safest for capital growth, and
mm,
I think we're going to see the most capital growth in the next 3 to 5 years. A big
yeah.
driver of that is actually the e-commerce boom. Like what
Mm,
happened, especially COVID kickstarted it, and why we've seen about 30% rental increases. Is everyone started wanting things quick. So all the big companies need little satellite warehouses to be able to send stuff really fast, which brought down vacancy rates. That's not changing anytime soon. However, there's also been a bit of a shift even for suburban retail. I still think suburban retail is going to be a strong performer because as we have
mm,
technology, people want human exposure. They want to go and they don't want a robot to cut their hair. They want
yeah.
like the chat. It's the same as like I've got a $4,000 coffee machine at home. I still go out to the coffee shop and say hello to the barista
Yeah.
and get out
It's a
talking to
human
someone.
interaction.
There's
Yeah.
human interaction, but then there's also ones that necessity. You still go to the
Mm,
doctor, you have to go to the doctor, you have to get your hair cut. Shopping for short term, convenience store type ones still do so. There's something there. Office space, I think there's opportunities, but as long as
mm,
you're willing to take on the risk. So you'll either need
mm,
more capital and be able to handle the vacancy rate, or do a value add. Look at maybe buying like a whole floor and subdividing it up into smaller tenancies or changing the use a little bit. So there's some options there as well. But as the main theme of this episode is commercial, I think is going to be a front runner for the next 5 years.
mm,
Residential's had so much growth in the last 5 years.
mm,
Commercial's had a little bit less, but that's why it's going to drag on. So typically, commercial will flow from residential about 3 to 5 years later because the leases are so long for you to realize the
yeah.
value at a time. So we've had like 70% capital growth in most regional markets. Commercial's only had 30. So I'm not saying it's going to double in 5 years, but I can definitely see another 30, 40% growth coming. Well, the demand's there
Wow.
anyway.
Mm, I think like we will just answer the last question. It says, how much importance should be given to land to asset ratio when it comes to
Oh, again, it's probably the same answer for residential. Obviously, the more
mm,
land you have, the more options you have. But I'm being mindful how to answer this one. It depends what asset class you're buying. So
Yeah.
like, so for instance, the little shopping center I bought, I showed you that like I bought that because it's got a good land component and I'm not utilizing it,
Um.
which gives me options down the track. Like I could build a residential on top, I could build more retail, I could build townhouses, knock it out. There's a pro and a con of each. So I'll strip it back to industrial, for instance.
Mm-hmm,
If you've got big block of land and your industrial property is only taking up 30-40% of the land,
mm-hmm.
that's great for future value add because you can build another warehouse, you can knock down the current warehouse, gives you options. You've got some really good options. However, if you're buying for cash flow, that asset is not the best utilization for rent because
There's no
yes, it's
space.
great for land. You might argue, oh, I've got more land, I've got more options, I've got more capital appreciation because I've paid more for the land, but you're not getting
Mm,
more rent because you're not utilizing the space.
definitely.
So
Yeah,
I
yeah.
would rather buy the one that's filling 80% of the land and get
Mm,
double rent. And because that's going to help me pay it off quicker, it's going to help me kind of get a passive income. And so there's that balance there. The comparative would be for if you're buying a residential property, let's say you go and buy a house on a 500 square meters of land. You could also go buy a house on 1,000 square meters of land. That will probably rent for the exact same as the 500, 600 square meters of land one. So your income's actually the same, but you've got a bigger land play. That land's not free. You've probably
yeah.
paid an extra 20% for that future capital growth or the development play. So the same applies to a commercial. I personally, again, I know I just showed a shopping center that didn't utilize it. If you're new to investing, unless you kind of know what you're doing, I'd try to get a good land utilization. But again,
Mm,
what's better? A brand new building, a concrete tilt-up panel one, a tin shed, where are you buying? There's so many variances with it, and every commercial needs to be assessed on a case-by-case basis, which I think is a good
mm,
way to end this discussion is
yeah.
never compare commercial properties. Look at your own individual asset, its pros, its cons, how it fits into your strategy, and make a decision based on that.
Yeah. Thank you so much, Steve. I think some of the people are asking, how do we get Steve's book? How do we contact Steve? That's good. That's good. What we'll do is we will actually send out the recording and an email just to thank everyone for joining today, and we'll have Steve's details. As you can see, Steve can talk forever, so you will make sure that he really, really, he's what the value that he can give is so valuable. Like he's so transparent. So I hope that all of you guys really find today's session very insightful. If you are starting your own commercial property journey or have any questions, or you are already a sophisticated investor, have any questions that you want to speak to Steve, or regarding the commercial lending side, you want us to review your financing, feel free to contact me, and we love to support you. So again, really thank you so much, Steve, for your time. And thank you so much everyone for joining. Yeah, thank you, and I hope everyone have a good night.
Thank you so much. Yeah, if anyone wants direct contact with me, email
Yes,
Jocelyn and she'll do
yes,
an email and try direct to my
yeah.
email.
We will send out an email with the link and the free gift and also Steve details after this.
Awesome. Thank you so much,
Thank you
guys.
so much. Thank you. Bye, everyone.